Hello, everyone, and welcome to today's discussion on institutional capital and the Solana ecosystem. Institutional interest in Solana and capital as well has accelerated significantly, but we all understand that the adoption is only a part of the story. Today, we've got a beautiful panel. We're going to be covering questions around data reliability, staking infrastructure, what actually does it take to deploy capital at scale? That's something we'll be covering today. I would like to start with the quick round of introductions. Please, dear speakers, tell us who you are, and I would love to spice things up with one thing about institutional enterprise Solana that you think is widely misunderstood right now. Ben, I would love to start with you and then pick the mic.
Yeah, of course. So, hi, my name is Ben Harvey. I'm a digital asset researcher at Keyrock. Keyrock's a global trading firm at the forefront of market making, asset management, OTC, and options trading. I think probably in context of today's discussion, we specialize in providing deep algorithmic liquidity and institutional execution of both centralized and on-chain venues, obviously with a significant activity on Solana. In terms of a misconception, I guess when most people think of Solana, they typically think it's relatively retail focused, particularly because of that kind of meme coin boom that Solana had and then continues to have really even today. So I guess the misconception would be that actually from our seat, market making and handling flow, we're seeing volumes are robust and we've seen actually growing sophistication in terms of inquiry and execution on Solana.
Thank you, Ben. Happy to have you here today.
Okay, I can go next. Okay, I'll take the mic. Thank you, Ben. So my name is Alex. I'm a lead research analyst at the Big Whale. So we are a leading digital asset intelligence provider in Europe. We're based out of Paris, although I'm in Serbia currently. And I do produce research for the Big Whale, host my own webinar called Future Finance. And also I'm doing a committee intervention at the banks and the clients that we have inside of our portfolio. One, regarding the misconception, I would say that to build on top of Ben's point, that Solana is not meme coin casino, and that give it enough time, like 2 to 5 years, I think Solana is going to be a NASDAQ 2.0.
Thank you, Aleksandar. Completely agree, by the way. Thibault, please go ahead.
Yeah, hi guys. So my name is Thibault. I lead staking and DeFi at Sygnum Bank, which is, I think, the world's first digital asset bank. We're based in Switzerland, but we have dual headquarters also in Singapore. We also are in the Middle East. And yeah, so as you can see from my title, we definitely do staking and DeFi. As far as the take goes, in terms of institutional DeFi, I was trying to think, what does it mean even institutional Solana from our point of view, which I guess we are the institution, even if it hurts me a little bit to say that because I was so long a DeFi degen and in the trenches. And I think I have two thoughts. Like the first one is, I'm not sure that the institution necessarily from their point of view think institutional Solana, institutional ETH, institutional this and that. Like maybe Bitcoin has its own space a little bit, but for us it's very much are you gonna do something on the blockchain or not, and then are you going to do it for yourself or for your clients? So that's maybe the first framework. And then just maybe for the specific take, I looked a lot at the recent institutional adoption, not just on Solana, but Solana has done a lot the last 2 months that I saw. But what strikes me is a lot it's still like the blockchain is still acting as a settlement layer, and a lot of the stuff is still not being kind of custodied there, right? So when you see all the stuff with a stable coin, which is extremely cool, but it's kind of still not deployed directly by the institution on chain. So I think that will be very interesting to see if that evolves. And I'm gonna stop here for now.
Thank you, Thibault. It's a really interesting take, and we're definitely going to be covering it later during the webinar. Catherine, I know that you're at the event today. Thank you again for joining us. Could you please pick the mic and briefly intro yourself?
Yeah, absolutely. Thank you for having me here. Catherine Gouvier, Head of Product for Digital Assets at the Solana Foundation. From a foundation perspective, we are now actively building a product I would call it more from a public infrastructure perspective, to think about how we can better support our ecosystem players, as well as growing the Solana network to drive more enterprise and financial institution to come on chain. I would say one of the biggest misconception or gap that still current institutions have is the fact that I think there's a dichotomy that in many people's mind, that they think public chain equals still sort of the Wild West, whereas if you want privacy control or being regulated to do regulated work, you have to choose something else, but potentially sacrificing liquidity, and that something else is going to be more like a permission setting or private setting. Now that misconception is being closed off because on Solana, as everyone knows, we have some of the biggest names such as JP Morgan, Visa, MasterCard, Franklin Templeton already building live things on Solana. But I think it's still the lack of awareness in really appreciating what technology can deliver, and the important point being that being on a public chain and supporting regulated financial institutions can absolutely coexist, and it's a must, because if you really want to benefit from the blockchain at large and to inherit the underlying security, inherit the underlying unified liquidity from what capital market can bring you, you have to go to public chains. And Solana is right now the strongest chain to unify all of that together. So yeah.
Yeah, maybe on that point, it's interesting because last week I was also talking at Point Zero in Zurich, and that's highly institutional, right? And super high entry ticket, mostly old people that work in TradFi. And what really struck me, it's the discourse really shifted to what Catherine was just saying now, that like very few people were saying, oh, we're going to build our own chain, we're going to do our own stuff. Like maybe they do some little thing on their side, but then you settle or you interact with the main chain. And a lot of discussion was also around, okay, can you obfuscate a bit more the transaction, because these blockchains are way too transparent for many financial institution. And for me, it was really fascinating to see that nobody was even saying, oh, do we even need that? Like super senior people from very big financial institution were definitely now talking, okay, how am I going to use now this public chain?
The narrative definitely shifted from where we were, for example, even 6-8 months ago. And I'm super excited to see the progress that Solana itself, and with the help of Solana Foundation, achieved recently. Thank you very much for all the introductions. Myself, I'm going to be moderating further chat today. Liza, Balandina, leading Solana ecosystem at p2p.org, that is building infrastructure that makes institutional Solana participation possible at scale. Let's twist our conversation to the actual institutional landscape, answering the question of who is allocating to Solana, with what mandates, and what exactly is driving the decision versus what is still holding the capital back. I'd love to start with the question to Aleksandar. Given your research portfolio that covers many profiles, what would be the honest answer to which institutional profiles are still mostly talking about Solana rather than actually deploying? Where is the separation between two groups right now?
Yeah, thank you, Liza, for the question. Well, yes, through our research, through my research, I talk a lot with institutions. So because we are fully like B2B focused, and when I mentioned Solana, a majority of very big banks that have a lot of compliance rules to satisfy say, okay, but like this asset is either like it's extremely volatile, and how does it compare to Ethereum? So their first reflex is to compare it to Ethereum, because they heard or they saw that Ethereum has the highest TVL, and that Solana is emerging, or it's already fortified itself as a valid competitor. And but they say to me, okay, so how can we explain to our risk board committee that we should allocate to Solana? And the compliance is the number one prohibitor or inhibitor for them to allocate. Now, with all the ETFs that we had since the early this year, and the successful launches with VSOL and other products, it makes stuff easier. But still, as for the entire crypto, Solana is very linked to the broader market movements. So when the ship is sailing down, the capital allocation to the asset as an investment product tends to lower, to slow down. And they are like, okay, we're going to stand on the sideline to see if the Solana is going to transform itself, become either less volatile, or be like, this is product that from the risk reward perspective is okay for us to introduce in our portfolios, and also service to our clients, which is easier than holding it as an investment vehicle. And aside from that, I think that massive, very, very, very positive things have happened in the Solana space, in the Solana ecosystem. Solana really developed, and it's actively looking towards actually, bridging over that compliance issue that's tied to the risk committee of these big institutions.
Thank you, Aleksandar. I 100% agree with the shift that is happening within compliance field that took up the majority of pushbacks from the enterprises and institutional players, answering the question whether or not to go all into Solana, or not even all in, but just to dedicate a part of their portfolio. I'm excited. Yeah.
I want to add one more thing. So I know Catherine mentioned it. The true, let's say, like the development is happening on an infrastructure layer, on actually what's BlackRock, Franklin Templeton is building, Liza is building. So that's, in my mind, is completely separate from token at the moment. Token as an investment product, and that's the thing that I wanted to add just to that. But also, like portfolio allocations, although they exist today towards the crypto assets, so institutions are acquiring crypto assets, it's still very, very small in comparison to their total AUM.
Thank you, Aleksandar. We've got Thibault representing highly regulated entity here, right? And offering both vanilla staking and DeFi products that takes up more of a contradictory part of any institutional portfolio on Solana. Thibault, a question to you. In practice, are clients actually using both right now, or DeFi is still mostly a conversation? And where exactly the compliance itself creates that friction on DeFi?
Yeah, so for sure, the bulk of the assets that are deployed, so which are not just held in custody and doing nothing, is on staking. And there we kind of run our own validator. Obviously together with you guys, for example. And then we can talk a little bit about the more technical side later. But for sure, there we see a lot of demand from clients, which can be high net worth individual, but it can also be other banks. So we run staking for other regulated banks in Switzerland. And this is kind of, I would say, the main demand. for DeFi, this is not a per blockchain discussion that we have with the regulator. It's more around the concept of DeFi itself. And there we have some projects which are live. But if you think in terms of pure DeFi, so the client can come with us, they have their wallet with us, they do an API call, or they stake from the UI, and sorry, not stake, but they would basically deposit maybe in a pool or do a swap or something like that. There we are very, I would say we have a lot of discussion with the regulator, which are very advanced. So I cannot say too much, but maybe I can just say the two main point where you struggle as an institution that you really need to tackle. And the main point is this. So either if you put the assets on your balance sheet, then it's kind of fine. You can do a lot of stuff on DeFi, but this kills a lot of the business case for a bank. So what you want is you want to have the assets off balance sheet, which also is nice for the client, because if your company goes down, it doesn't go into bankruptcy estate. It's super smooth, right? But of course, if you want the asset off balance sheet and you want to place them in DeFi, then you need to prove two things to the regulator. You need to prove to them that all the assets are segregated at all time, which, okay, you deploy them from a vault, from a segregated wallet. That's not too hard. And then with the pool, you usually get a receipt token. You have then other problem like the travel rules, and you have a bunch of other things to fix. But this part alone is probably okay. But where it's very difficult is you have at the same time, you have to prove that the assets are available at all times. They're kind of liquid. And so if you think in terms of a pool, like a pure lending pool, what happens if you have a 100% utilization rate? So, I bring some SOL, and then Ben brings some USDC. Then I take all the USDC to buy a bunch of Lombo because I can then get them at a deep discount. I don't mind paying a huge interest now on this USDC. Ben is kind of okay because he gets a huge yield. Maybe then Catherine and Alex say, oh shit, the yield is great, we're going to bring more USDC. So for us DeFi people or banking, we're like, yeah, the interest rate taxes are clearing, it's fine. But for the regulator, they will say, yeah, but the money is not in the pool anymore. And even though it's over collateralized, it's not liquid. So I just give this as a concrete example of the sort of very, very deep discussion we are already at this level with the regulator. So they understand quite well how this stuff works. And you need to kind of find a solution to all these type of problem before you can really deploy this at scale. But I would say, I feel like we're getting very close now. Of course, there are other ways how you can do DeFi, but if you really think in terms of super cool, I have my wallet, I can press a button, I can track everything that happens on chain, then you need to fix these problems.
You touched a really important topic that I was also going to highlight a little bit further, the liquidity. And I guess, Ben, you'd be the best person to highlight the liquidity angle of all those intricacies of onboarding to Solana. Is current Solana liquidity actually deep enough of a size today? Or institutions still hitting walls when they try to deploy at scale? Where is the honest answer from your seat?
Yeah, so I think having this conversation now is a very good time because Solana is holding up very well, especially on chain relative to a few of the other ecosystems that we look at. So obviously it's important to kind of caveat this with the fact that with some kind of broader market context, we've seen a cool off in volumes alongside sentiment and price across the board, especially when you look back to kind of like September, pre-1010, when Solana is trading up 250. If we come down to 2 year console, volumes are going to do the same thing. But having said that, on chain on Solana, I mean, like even just 2 weeks ago, we saw $7 billion worth of spot trading volume. That's more than we saw on Coinbase and Kraken individually in the same time period. So on chain, Solana has held up incredibly well. Not only that, but also within the ecosystem, we've seen certain subsectors performing incredibly well. So I'm sure that everyone here probably tracks tokenized equities. On Solana, they printed their daily all-time highs last week. I think it's somewhere between $500 and $650 million a day. So a few great signs in terms of liquidity there. If you look at, obviously centralized exchanges didn't perform as well as that in terms of liquidity, but if you push even further into kind of your traditional venues, spot ETFs or even the treasury companies, you're looking more like tens of millions in daily volume, which is much smaller. So we are kind of seeing, I suppose it's the opposite to what we were saying at the start, right? In terms of Solana is becoming more institutional, but we are seeing with the more degen-esque of venue, the volumes are much, much higher in today's sentiment. But there's absolutely no doubt about it that these volumes are meaningful enough for institutional execution on core pairs. The key problem, though, is that it requires high-quality order routing. So from Keyrock's seat, what we're looking at in terms of providing daily liquidity is optimizing around cross-venue flows, be that cross-venue within Solana on-chain itself, or cross-venue in terms of across centralized exchanges, on-chain decentralized exchanges. And also looking at things like inventory management, et cetera, et cetera. So institutions I wouldn't say they're routinely hitting walls, committing capital, but they kind of require this planned execution, perhaps some OTC strategies thrown in there as well, just to pull all of the liquidity together.
Thank you, Ben. And from our perspective, the ecosystem itself became quite a mature space recently, given all the launches from the enterprises and what Solana Foundation does right now. I really do appreciate Catherine being on a webinar with us today, because herself and the Solana Foundation sits right in the epicenter of the ecosystem. Catherine, would be a great time to ask you to ask your position and your take, which institutional profiles actually deploying right now versus who are still in the exploration model, and what is the foundation, how does foundation effort look like to accelerate ones that still have huge pushbacks?
Yeah, I think we have many different TradFi players from different industries, like actively building on Solana. Last week we had MoneyGram announcing that they are now becoming a validator on Solana, together with building on our platform, a product platform for Solana developer platform. Today we just had this big announcement coming from like 100+ different companies creating a stablecoin consortium called Open Standard, and Solana is one of the few chains that's going to be tested from day one to support this new stablecoin usage. We also have a lot of asset managers and banks already tokenizing money market funds, tokenizing bonds. We had Daily Gifford, we had Old Funds, which is another big like distribution platform for different kind of funds in TradFi, and they are now actively doing tokenized fund distribution. They're now onto Solana as well. So we're working with all kinds of players to participate on here. I guess the reservation for some, as I said, I think it really is a matter of understanding and familiarity. I think a lot of the times when we have conversation for the first time with institutes who don't know the ecosystem well, they just like to know who else already participating or building on Solana, and as reference points. I also do think from a tech understanding perspective, majority of us come from, the learning come from EVM as the first and foremost, and then you move on to SVM. So, you would expect for many enterprise engineering departments, the thing they're not familiar with is everything to do with the actual Solana protocol. So it takes time for sure for them to be familiar and actually having a deep understanding of Solana for itself, as opposed to, I just always want to compare, what's the parity I can achieve, say on Ethereum or another EVM, and then put it onto Solana, because not all the time it's apple to apple. And sometimes, we have very, very unique native features on Solana that's just simply not applicable on the Ethereum side. So I think those are the different factors that's taken into account. And lastly, I think also just the fact that some of the institutions, due to regulation, are still not able to hold on to, crypto assets directly, and that includes Sol. So for that reason, you could imagine some of the biggest institutions might not want to have a direct exposure to the underlying Sol token and Solana, and hence maybe it can't be a validator, as a good example. But I think, with the changes of regulation and also how things can be done, you don't have to directly hold it, you can delegate it to other third party to then manage it for you. I think there's many different enterprise solutions, if you will, that could have more of the institutions to be real stakeholders in the Solana system. So then, they have a stake in the game, and then they'll care more about the ecosystem and truly support and build onto it.
Thank you, Catherine. You highlighted 2 points, which is familiarity and understanding, which are united under the umbrella of common context. And I think past 6-12 months, enterprise players, institutions really gain much more of that. And that is something that's been lacking for a while. And I really do appreciate all the ecosystem efforts that are collecting these beautiful portrait of Solana piece by piece and actually communicating it to all those institutions who are still just poking around their Web3 blockchain DeFi path.
Yeah. Sorry, is that a question? Or
no, it's just my sentiment about where Solana is right now, and highlight that the more context, the more adoption would be there for enterprises and institutions.
Yeah, for the asset on balance sheet, I have an interesting example. So we custody or we do staking for many other banks in Switzerland, like for example PostFinance, which is I would say one of the biggest systematically relevant banks in Switzerland, and they have actually exactly the problem that Catherine describes, which is that for them they may hold some of the asset on the balance sheet, but it's highly looked on by the regulator. And so, for example, one main problem that most of our B2B clients have is they don't want to pay the gas fee on chain because it's a huge pain in the ass for them. So we had to build a whole fee sponsoring on ETH and Sol, just so that basically on chain only the money of the clients moves. We sponsor everything, and for that, for example, Solana is very nice because they basically have embedded, sponsoring from another wallet, which on ETH we have to do some relatively, contorting with MEV relayers and other fancy stuff. But with Solana, it comes kind of out of the box, so it's nice. And then you need to fix or to solve exactly this type of problems. But I would say. That's a good example of why it's also not a killer criteria, right? If you just tell to the bank, yeah, no worries, we'll pay for the gas fee, we'll send you an invoice in Swiss francs or in dollar at the end of the month, then they're happy. So also, every problem is very often its own opportunity for us to innovate and build something and then make the clients happy. So as long as it's not the government telling you are forbidden to own any of these assets, then generally you will find a solution.
Speaking to more and more institutions that are already on Solana, recently myself and our team had come to a conclusion that there is also a huge data question that is blocking enterprises with decision making. So I would love to shift our conversation to that angle a bit. Given specifically that Solana Foundation recently launched the data aggregation layer, the solana.com/data, that actually surfaces all those data inconsistencies that are holding back enterprises. Catherine, one more question to you. Could you please walk us through what it actually delivers today? I mean, the aggregation layer, and what it still does not, where the roadmap would need to get it, so enterprises have full visibility into what they commit to.
Absolutely. I mean, this is a really exciting effort that our data team has led. And I think what's really game changing is like first we open source all of the data sources. And what's kind of revealing, I think, when I saw it for the first time, is like, even though every single data is transparent on blockchains, it's still hard to identify or summarize exactly what is the source of truth, because some of the metrics you look at, it can be vastly different, right, by billions of dollars in terms of like the actual calculation by one data analytical provider versus another. Now, that's the part in which I think ultimately, and the goal is with this open source like platform in which we aggregate all these data and compare them one against one another, these data providers will then come together and reconcile in between one another to really understand exactly where that discrepancy is, because we should have like a single source of truth rather than 5 or 6 different ones. But I think, what's important, of course, is data is everything. We need to understand all the important metrics that are the most relevant to think about for institutions, especially, what is the real infrastructure you want to build on? And how do you compare the KPIs or performance metrics against one another? So I think for now, what we have is, for example, stablecoin supply, DEX volume, fees, active addresses, transactions. All of these metrics are being benchmarked side by side across, I think, like probably about 8 or 9 different data providers right now. We'll add more. And also the goal is we'll expand the set of metrics that will include to touch on more, say, to do with real world asset tokenization, as well as to do with on the payment side and DeFi. So these things are going to come up, but the goal is let's open source everything. And also let's also use this as an opportunity to collect better data, right? We need better labeling, better understanding about what's the actual usage of different transactions under the hood. So I think hopefully through this is a collective effort that we can push like different ecosystem players to have a more consolidated approach, but also just more data availability in general.
If the end state isn't just visibility, but rather an actual solid standard, I think it's a fallback question to all. Who do you think should build that? Should the foundation itself initiate and kind of moderate, or is there a better room for more of an independent provider to set the bar?
I can start and I'll let other people to chime in. I don't think it's the foundation to set the standard. I think it's Solana network. I mean, ultimately, all the data is on the Solana network. So the source of truth lies within the network itself. It's about the methodology and selection of how you label, as I said, and how do you actually calculate these data. Again, the truth is out there, but I think, and I don't think it's a single provider who should be setting the standard. And that's why we want to be neutral and we want to be including all the top players who are collecting data right now, because we put it out there so that it gives them a chance to really coordinate and reconcile between one another to come up with, let's call it, the right way to approach and to really extract the truth from the chain itself.
Yeah, I mean, I agree. I think the single source of truth is the consensus itself, but then I think this is also where you see still that Solana has some little room to grow. For example, in terms of the clients, this is something where we get a lot of pressure from the regulator, even to see if the validator we run on ETH, if we have a good split in they don't want a super majority clients. This is, to be fair, a problem that every other chain has, except at the moment ETH, and even ETH, they're slipping back to majority client regularly. And I think in general, in terms of fetching the data and being able to read it, I think the foundation can play a major role to initiate and steer and help the people. But if for a blockchain to become truly strong and independent, it can't be the foundation, right? It needs to be an independent ecosystem, and actually the more the better. But of course there is a limit, because this costs a lot of money, and you will not end up with 10 different provider. But I can tell you that these are typically the sort of stuff that a regulator and auditor will look at. Say, oh, but what if these guys go down and now you can't read the information anymore? This is a legit question we get. So it's not trivial. And before you want to have hundreds of billions of real world assets on the chain, you kind of have to tackle this problem, or at least I think it's fine if it's not there yet, but it makes a big difference if the ecosystem has a plan to get there, versus it's a nothing burger, we don't care. And then I think it can really steer in a boardroom where you have people that actually make this type of decision on which chain are you going to launch your pilot. And I was really surprised to see that a lot of the regulators and the C-level executive and the CTOs in this company, in our own or the one we work with, they are aware of these issues and they are thinking about them. I wasn't, honestly, before joining a bank and going back to the dark side, I was not expecting that they would catch up that quickly to this type of a topic, but they definitely do.
Yeah, I can also agree and say that in my mind, the Foundation did an amazing job with the segregation layer. However, I think there has to be an independent source of truth in terms of some kind of auditor for these stats, like we have in traditional finance, like the Big Four, that are doing all the audits for all the public traded companies. So that would unlock the or actually increase the allocators' trust to consider Solana more as an standard portfolio component, and also that would make them evaluate chain easier, to actually see that, okay, like can we actually trust this data point, which is very important. And sometimes discrepancy can happen, but the unified source of truth really, in my mind, solves this problem. One more thing is I look at it from the perspective of 10K versus 10Q. 10K is audited financial audited document at the end of the year, financial report for all these companies. 10Q is reported by the company also, but approved by the auditor, but not checked. And so you have to take it with a grain of salt. So this is exactly same thing here. And in everyday research, I run into a lot of different discrepancies in data when I write reports, not just for Sol, but for all chains, and they differentiate quite a lot.
The more transparency into where these data disagrees, but still no resolution or the unified source of truth to trust. That same question, in my opinion, shows up again in the moment we talk about staking rewards as well, because that's the exact place where the calculation gets tested. I'm very excited once again about the initiative that's been launched recently by Solana Foundation. At P2P, we ourselves dove deeper into data intricacies and what is the best way to deliver those intricacies to our enterprise clients, because it's the hottest topic across the board, right? Whose numbers to trust, whether or not we should pull up numbers from external source of truth whatsoever. Thank you very much for the input on that hot data topic. I hope more visibility, more familiarity, and the unified common methodology would come across very soon, because this would definitely ease our the pain of onboarding more and more institutions to Solana. Moving a little bit forward to the protocol rewards, also a very hot topic given all recent events, exploits on chain, how institutions are approaching staking on Solana validator infrastructure, DeFi, low-key and high-key DeFi opportunities, and compliance frameworks. Thibault, you'd be the best person to answer the questions about institutional grade validator infrastructure, because it's nothing less but a standard bar right now. What does enterprise grade validator infra on Solana actually need to deliver? What else? And how are your clients evaluating that today?
Yeah, Definitely, I'll jump right into this. But if I may, you made me think with your closure of the last argument, something around the data, which will tie with the discussion with the validator, because we run ourselves a kind of a Sygnum branded validator on Solana, and there we have two type of clients. We have the custodial clients or our own clients, for which then this question about, hey, how do you need to shape this validator is very important. So I will answer right away. But also we have the non-custodial clients. So basically other people can delegate to this validator. And I don't know that many institutions are actually doing it at the moment. And in terms of the non-custodial, for example, we use the Google BigQuery on Solana. We will definitely now have a look at the latest product that they announced. And we use, for example, Gito for calculating the MEV. So there, basically, we rely, for the non-custodial, we rely a lot on external third party. But then when it comes for our own clients, you need to be extremely sure and precise. And, if you're going to book rewards, you book them in your core banking system. And there, the regulator, they don't take kindly to you booking bullshit in your core banking system. So there, we basically run full nodes. We do personal indexing. Every 2 epoch, we really calculate everything from every client on every wallet. And then we basically run a shadow instance from a third party to see how do these rewards compare that we calculated versus what another person tells us, So exactly what you were discussing before, and that's kind of how we do it today, right? So that's why I like this discussion, because that's exactly the type of problem we had 1 or 2 years ago when you say, okay, now you want to offer Solana, you want to offer ETH, you need to calculate the reward. How do you make sure it's correct, Because you definitely don't want a client to go or the regulator on a wallet and say, there's a bunch of, why did you never pay this reward? Or, where is this money going and you don't know? So then to conclude with your question on the validator, I think there is a bunch of stuff on chain that we look at and that our clients look at, because for sure, when all goes well, all the clients, they just want the best performance, the best APR, the best uptime. But at the same time, they have a very keen interest to know, okay, if you're not going to run the node yourself, how do you make sure that you can always recover the funds? So that's how it's set up with the withdrawal key and all that good stuff. But also it's, who is running the node? Do they have like SOC 2 type of certification? This sort of, what are the credentials? And for example, P2P is amazing because in many cases, you were the one to run the validator for the first time for some chains. Definitely for a long time, you have a good track record. And so you run this node also on a test network, and if you can show all this stuff. But then there is what's really important is also, it's very boring, but it's on the reporting side, right? That you can then do nice reporting, and you can trace everything for the client, where the reward coming from, how much. Maybe a stupid example, but MEV is considered in Switzerland by the tax authorities as VAT. It's taxed under the VAT. And consensus is not. So consensus, they say, okay, it's minted out of nothing from the protocol. It's shared evenly, fine. But MEV is basically people paying for your service at the end of the day. So, the tax authority, when they want to understand a blockchain, they can go very deep. And, when they came with this argument, we were like, oh, shit, yeah. I mean, it's very hard to counter-argue against that. But then, when you work with an institution like PostFinance, they want to know exactly how much is consensus, how much is MEV, right? So how you set up your validator, how you get this data is absolutely critical. And then maybe the last point, which is regarding the validator, it's not something we do, but it's definitely something that we discuss from time to time, and we look at is do you want kind of an OFAC compliant validator? Are you gonna whether are you gonna let any transaction pass or not? I think this is a big debate. But definitely, if you have this ability, you may not use it, but it's nice to have in case the regulator comes and say, hey, we want you now to use only OFAC compliant transaction. For example, I'm not saying this is cover all the cases. But yeah, I don't know if this really answers your question, but these are a few thoughts I had on the topic.
Thank you, Thibault. It definitely, even if it does not, audience will decide, but it gives us a huge context on the way that Sygnum, for example, operates. And it touches upon really important stuff such as data consistency across different sources, how the operator serves those appetites of clients who needs the transparent data, et cetera, et cetera. And I totally understand all the pains that are connected to data. So thank you very much for highlighting that.
So maybe I think if I think about what I just said, like it shows you that our obsession is, for sure, it's a bit technical, but it's much less technical than maybe the industry expert would think, or maybe even the Solana Foundation, or they would be, oh, you want the best, most beautiful validator. It's like, yeah, sure, we want a nice validator that makes a lot of money, but we are more concerned about reporting and if you have slashing, Solana at the moment, I don't think we still have slashing, right? But if you start to introduce slashing, how does that work? Like these are kind of the key question then.
Right. And I'm also curious about your take on in these regards, on the DeFi positioning within that institutional grade infrastructure. How differently institutions approach DeFi on Solana, and specifically where the compliance limits their appetites. Let's take, for example, LSTs and a new framework that's been introduced recently, the native staking vaults, native staking as a collateral. I would love to use that as the main reference frame. Aleksandar, maybe you'd shed some light from your perspective, from the seat where you are.
Yeah. Thank you, Liza, for the question. I'm just collecting my thoughts in order to generate the answer. Okay, so regarding the appetite, so the appetite is definitely present. I gotta say the yield is very attractive. It's not the stretch type yield, which is good, because when you see a yield above like 11-12%, it screams all the red flags that you can possibly have inside of any traditional market. But in my opinion, where the compliance draws the line between appetite and what's actually real is, again, depending on the risk committee of the institution. I think that they are still discovering how native staking can actually transform the business for the better by generating the cash flow. But if you introduce LSTs into the picture, they get completely confused. I'm not saying that people personally are confused, but compliance rules are confused. Like, okay, you are adding additional systemic layer on top of the baseline, and that creates risk. So what will happen if, for example, JIDO goes down? Like, are we gonna, how much are we gonna suffer? And definitely, it takes time for them to understand like liquid staking component. But then organizations such as yours, like B2P or Kiln or Figment, really help, because you build trust, between the actually allocator and the reward. They all want to have a reward without blowing up completely like their portfolios. And this is where compliance draws the line. Now, of course, what will make appetite grow more is that as the industry moves forward, I think that people will get more and more educated on that. I remember first time when I came across LSTs, I was also confused, like what is actually the use case of the LST? Why am I taking another layer like of systemic risk on top of the native Solana staking? But at the moment, what I see in talks with a lot of institutions who are actually actively deploying Solana, which is very few, if we remove treasuries, is that they are completely fine with the native yield so far. They are more concerned about the price fluctuation if they are more passive on the investing side rather than active. So yeah, I hope this satisfies your question.
Yeah, I appreciate it. Ben, you've been quite silent the past 20 minutes. I would love to take your take on what we've just established, right? The native vanilla staking is the simplest, the safest way to optimize the portfolio, right? But the DeFi is where the friction lives. So right now there is a middle category that covers vaults infrastructure, right? That collateralized native stake without requiring a full DeFi posture. Do you think this is actually like a structural bridge that institutions can use, or it's basically relabeling of the same old risks?
I mean, if you're looking at it in terms of underwriting, it's definitely just relabeling the same risk. You have to underwrite the same risk, but it's packaged in a way that makes it slightly more attractive for different players. I mean, I can't speak too much to the compliance side, but if we just go back to the LSTs, for example, Solana is set up in such a way that it's way more beneficial for our clients. A lot of the things that they'll come and ask us about is liquidity. And if you're looking at liquid staking token on Solana, without getting too technical, what you're really looking at is a staked account, which then can be rewrapped and wrapped into other things, right? If you wanted to tap into any liquid staking token liquidity, you could almost instantly unwrap that on Sygnum or another platform. To something like Solana with an LST is much more attractive than, say, Lido and Ethereum, where actually you suddenly have these lockup periods or you have these liquidity constraints. So there's a couple of different things you should be looking at there. But yeah, we're quite big on vaults, especially when you have these liquid staking tokens within them that are relatively liquid and we can generate yield on. I think yeah, they offer some pretty good payoffs for clients.
Thanks, Ben. Well, the red line is still the same, right? Staking infra has matured, but the compliance side of scaling is still clearly being worked out. Zooming out of that, everything that we've just covered depends on what actually moves first. What exactly needs to happen for this all to scale. With the MoneyGram, the Bailey Gifford, Tasbank, and Micron Technology among recent ecosystem highlights, happened all in just one morning, by the way, which was such a bomb out there. But still, everyone says that the bottleneck is the regulation, or, for example, the custody technology. Though the US ETF approval happened, institutional custodies exist, and staking infra, the enterprise staking infra is live. What is the real reason that capital hasn't moved yet? The yield is complex, I understand, but what is the honest answer to institutions still not trusting the chain that much? What do you think?
So I think that there's something really important that Catherine touched on earlier, which is that obviously the regulatory environment's got much better in the last like 4 years, Trump administration really. The custody side has got much better, even if we look at something like Fireblocks or going all the way through to an institutional wrapper like an ETF. But one thing we haven't spoken about yet, which is super important, is that actually a lot of these big pools of capital have their own investment mandates. They have their own investment policy statements, which won't allow them, like completely prohibit them from directly holding cryptos, right? And this applies to anything, by the way. It applies to Bitcoin, it applies to Ether, it applies to Sol. It even applies to products like Stretch, like digital credit, where sailors try to, completely deconstruct the volatility in different products there. Institutions like large pools of capital, pension funds, insurance funds are turning around and saying, I'm not willing to underwrite the underlying assets, which completely prevents a lot of them from pushing into the asset, even though we have ETFs and different wrappers. Now, what that ends up leaving us with is the more flexible pools of capital. So it might be crypto native institutions, family offices, high net worth individuals, these kind of allocators. But I think until we get to a point where these kind of investment committees or mandates are changed, which are historically quite slow to change, there probably won't be this huge wall of capital flowing in that everyone seems to be expecting.
Yeah, maybe if I may also say something on this. I think, like, now we talk a lot, they will own ETH, they will own Sol, and of course, I mean, we all want our bags to pump, so fair enough. But I think for me, what I would really like to see, I mean, I still deeply believe that eventually all assets will exist on chain, and I even think the word tokenized for me always rung a bit wrong because it implies you're copying on chain something from the real world. But for me, the stuff needs to be issued directly on chain, and this needs to be the source of truth. And then till a judge says, well, if it didn't happen on chain, it doesn't happen. You know, like a lot of the stuff that we build on this blockchain is a bit pointless. Like we even tried a very big pilot with proof of solvency. You know, we built some very fancy zero knowledge proofs for this stuff. But you know, if somebody can off the chain then just issue a little 300 million loan with seniority over your fancy blockchain stuff, it's still a problem, right? So I think what I also would really like to see is real assets coming on chain. Also, this also goes to the yield question. So I think the yield for the native chain itself, especially if it comes from some legit activity on the chain, is nice. But if your yield is just where's the yield coming from? If it's just, you know, oh, don't dump my token, so stake it and I'll give you more of my token, this goes nowhere, right? So we also need to see real world yield and energy and human, you know, capital that flows into this blockchain. And I think we're getting there, but this is what's going to take time, right? Because you need the legal, it's not just the compliance, right? It's the whole system needs to slowly adapt. But where I'm a bit confident is I work a lot with big banks now and big financial institutions. And whereas 4 years ago, you had to even convince them to touch this technology, you know, with a 10-foot pole, now it's not even a decision anymore. It's okay, yeah, they want to do staking for their own client to make yield, but as they do this, they learn how this stuff works. And then, you know, when they ask me for a report, I say, you don't need to trust me, just go check on chain. And they're like, oh yeah, shit, that works. That's quite nice. Maybe I could cut down on my operation department or you know, and then suddenly I think this will make its way into the regulated entities, and they'll start to realize these blockchains, they are a standard setting format. You know, like if you think about what we had to go to have Swift, which took decades and so many banks to agree, you don't have this problem. Like Catherine said before, you learn EVM and then SVM, and then you cover, like, you know, 80% of all the potential use case you want to cover. I mean, we built a lot on ETH and Solana. That's and you know, at some point you have to stop because each chain. So for staking, you have to learn all these different chain, and we definitely do. And we can stake from Sui to Near to, but you know, like the stuff where you really put all your engineering department behind, you have to draw the line somewhere. But I think once you learn and you know how to do that, then the next step is somebody comes and say, hey, I want to put a bond now on Solana. And then for us now it's super chill, you know, to do that, because we learn how to do it through staking. We learn to do it with talking with the regulator with DeFi, and yeah. So I'm gonna stop here. But I think these are kind of the stuff that we need to see to be on chain, not just more meme coins, which even though I love them and I will keep buying them, even if they will keep going to zero.
Right. Appreciate it, Thibault. Just a quick heads up also to the audience and to our speakers. Catherine, I know that you got to run like in a couple of minutes, and I would love to wrap your participation in our webinar with a quick question. Maybe you've got some comments on the next wave of like what would be the most impactful thing on Solana in the next 12 months, the one that you're pushing, and your take on the most controversial institutional Solana narrative right now.
Let me think. I think the next 12, I mean, let's talk about the macro picture. The macro picture everyone's asking is about tokenization, RWA. So this is clearly the wave that we're going through right now. And, you know, on Solana, you can argue we've had the NFT moment, we have the meme coin moment. I think this tokenization is the next moment. In fact, even though they're very different products, if you will, that is being brought on chain, is the same kind of mechanism and looking for the same distribution and liquidity effect. So I think that's how you can think about the sort of similarities between them. Now, the real world assets obviously will be interacting with stablecoin. So it's kind of the two sides of the same coin. And I think we're very well positioned in terms of that, right? Because as said, we are like right now #1 chain for stablecoin volume and liquidity by many metrics. We continue to attract some of the world's biggest institutions who are looking for chain to issue stablecoins. They understand Solana is the best venue for them to do so. So I don't have any like concerns on that front. So you have the premise of already liquidity is on chain on Solana. Then it's let's bring more assets on chain. So I think that is happening already. It's just going to take some time for, as I said, for a lot of institutions to go through that on-ramping experience of what it means to come onto Solana. I think the one thing that, you know, we've been hearing from here and there from institutions on privacy, in a sense, again, oh, you know, I want privacy because if I'm a trading company and I want to trade certain assets, every single aspect of that trade has to be completely hidden, and therefore I have concerns about doing that directly on the mainnet. And once again, you know, this is why they chose some other chains that might give them a more permissioned offering, but then it becomes a POC because you can't really scale. You can prove you can be private, but you can't prove that this is commercial. Now that's a very different picture on Solana, and I think this is the misconception which I don't think. Well, it's also on us that we need to do more marketing and education per se to actually share with institutions. Like there's a range of privacy solutions we have already on the mainnet. So as an example, us together with Anza Lab, we just relaunched confidential transfers through Token 22 program, I think last week or the week before. So that's on the mainnet. You can use it tomorrow. So for all of the existing issuers, stablecoin issuers who already use the regulated token program to issue the stablecoin, they now can turn on this confidentiality feature to be able to do confidential transfers. We have something called Solana Private Channel that's being audited coming onto mainnet as well. We have a few other ecosystem solutions that are really targeted for enterprise use cases that are being built out and you know, going through a lot of iteration in terms of go-to-market. So I think a lot of these are very bullish trends, and hopefully, you know, we can get the words out and just for institutions to truly appreciate what you can realistically do on a public mainnet, which is a lot.
Thank you, Catherine.
Thank you very much.
Yeah, thank you for joining us. Really bullish to see what's coming next from the Solana Foundation. Have fun at the event, and thank you once again for joining us. Yes, a quick bridge from the previous topic, right? There is no single unlock. There is a huge things happening simultaneously in parallel. So Ben, let's start with you. The final question, the closing round. What's, from your perspective, the most controversial take on institutional enterprise Solana right now? What do you see from your side?
I think, kind of coming back to what I said earlier, I think that there's a bit of a blocker to institutions deploying on chain. By the way, I want to completely disconnect kind of building on chain and putting products on chain like bonds and RWAs, and then liquidity and volume, just trading in the actual asset, because they're separate questions. And personally, very bullish on RWAs on chain. But on the other side, I think that something people haven't really noticed is that the ETFs coming out in the last year, I think were actually almost a bit of a blocker for on-chain deployment itself. And it comes back to these kind of investment mandates that we've seen and that are relatively restrictive. I think that what you have is a setup where some investment committees are almost appeasing potentially like young analysts who are trying to push capital on chain and generate a yield, or push capital on chain and trade in certain venues, by saying, well, actually, we've already deployed to the ETF wrapper, we don't have to do that anymore. And in doing so, you get this kind of blocker for on-chain capital. That's maybe one of the things that I think we're seeing that isn't being spoken about too much.
Yeah, thank you, Ben. Aleksandar, the same question would be for you about the most controversial take on Solana right now.
Yeah, so I'll say one thing, which is when the institutions decide to deploy on chain, I want them to do better analysis of the sector, because layer one ecosystem right now is too fragmented. So industry is not big enough for 10,000 layer ones. So great consolidation needs to happen. And I just ask myself sometimes how certain players can build on different chains. Of course, obviously, I'm not going to name them, but that's the thing, and that is sucking out the liquidity and also capital, redirecting it from the clear and obvious winners of the L1 ecosystem right now, and essentially the entire digital asset industry.
Thank you, Aleksandar. Thibault, your turn to shed some light on the most controversial parts of Solana right now.
Yeah, usually I don't like controversial takes, but then Sygnum prevents me from sharing them, so I have to neutralize myself. But maybe just to answer Aleksandar quickly, I think that's something I was thinking about, that USDC is kind of a more free and powerful asset than ETH, even in a way, because you can mint and burn USDC from Solana and ETH and move them around. And the layer 1 token, you have to go through a bridge, and it's kind of, I was thinking exactly about this topic yesterday for some other reason. So I think this is definitely an issue. I mean, the controversial take, I mean, I don't know if it's controversial, but for me, it seems like a lot of it is still a bit marketing theater, right? So we have big announcements, but as we said before, a lot of the stuff is not there yet on chain, either through real world assets or through on chain assets, and so I'm very hopeful, because the fact that the companies are even doing this announcement and they're choosing these chains like Solana is in and of itself very bullish, but I think maybe it may be interpreted as a bit more bullish than it really is, right? Because I think we, like, maybe let me take a very concrete example and close with this. If you really want to talk about institutional size, you need to have institutional size money on a DeFi pool that I can liquidate a position of institutional size and not have the whole market collapse, right? And we're definitely not there yet, right? So that's kind of why I'm talking about marketing theater, which is good. We need it, we need the publicity, and it needs to grow. You need to fake it until you make it. But that's would be a bit my take. It's not there yet, but I still see very positive sign, because I see also where we came from. I mean, you were talking about the Trump mandate and not the Genius Act, but without naming it, right? I mean, definitely it was a very different vibe 5 years ago. So, but then you had the ETFs, and it sucked a lot of capital, and yeah, it's still not there in a way.
Guys, thank you very much for your honest answers, hot takes, hot enough under the restrictions that you all might have. Thibault, I appreciate you surfacing all those real operational intricacies in the very beginning from the state of a regulated institution. There was, yeah.
We use it. We really use it. We use Solana a lot. We use ETH. There are 2 chains. It's ETH and Solana that we use. That's where I think the money is. We offer staking on many chains, but it's very clear where the traction and the attention is. And I get to use this chain on a daily basis, fix bugs, fix problem. I like recently Sol just said, hey, stake account is minimum 1 Sol. Well, guess what? We had a bunch of clients taking for 0.5 Sol. Well, what do I do now? So if you're a bank and you actually do shit on chain, you'll know this problem and you'll learn to fix them. And then I think you would be very well positioned to help other banks, or to maybe launch this type of product on chain next. So I think maybe this could be the conclusion, right? I think if you see banks and players just doing staking themselves, that's already a huge deal, because in able to do staking yourself, you really need to understand how this blockchain works. And I think you're not super far away from doing DeFi, or at the very least interacting with some protocols. So maybe I'll conclude with that.
I appreciate it. Definitely. And the infra layer is catching up faster than most expected, right? Which is also a good thing. Though waiting for the compliance stuff to finally wrap up and pave the way for the broader exposure. Anyway, wrapping things up, Ben, I appreciate your direct read on liquidity as well from your seat. That's honestly a voice that usually is missed from panels that I'm participating at. And Aleksandar, I appreciate the independent view on the above the hype. That's exactly the kind of specificity on profiles and risks that I wanted our webinar to have. Thank you very much again. Institutional capital is moving into Solana. Let's stay tuned. And even the data and compliance questions aren't fully closed yet. We're building the infrastructure that makes institutional Solana participation possible at scale. Dear audience, the replay will be available and the written recap would be right there within a week. Thank you all for the participation, for staying tuned, and we'll see you at the next one. Thank you all.
Thank you, Liza, for the invite.
Bye.
Bye guys. Enjoy
Goodbye.
it.
Bye.
Bye.